This set of slides is on the tactical asset allocation. So TAA, or tactical asset allocation, involves deliberately underweighting or overweighting asset classes relative to target weights in the policy portfolio in an attempt to add value. So it's active management at the asset class level. It can be conducted independently of the within-class investment decisions by using derivative securities, a cost-efficient means for changing asset class exposures. In that case, TAA can be described as an overlay strategy. So basically, you keep your portfolio, and on top of that, you have another portfolio in which you manage your derivatives, which are your short-term trading strategies for taking advantage of any underweighting or overweighting assets. So it's an overlay strategy. It's based on short-term expectations and perceived disequilibria. So we know from prior discussion that strategic asset allocation reflected the investor's long-term capital market expectations. The concept is logical because strategic asset allocation concerns meeting the investor's long-term objectives. The investor's short-term views may well differ from his long-term views, however. TAA involves tactical bets to exploit those differences. Economically speaking, it seeks to exploit transitory deviations of asset class values from the expected long-term relationships. An investor may make occasional tactical weighted adjustments in some circumstances, or may have an ongoing and more systematic program of tactical adjustments. Both can be described as tactical asset allocation. It can be managed in-house or delegated to one of the many professional investment managers who run TAA programs. So it's frequently based on the following three principles. The first one is that market prices tell explicitly what returns are available. For example, we could use dividend yield plus growth rate to estimate the return to equities. The second one is that relative expected returns reflect relative risk perceptions. When investors perceive more risk, they demand payment for assuming it. If expected equity returns are particularly high compared with bond expected returns, the market is clearly according a substantial risk premium to stocks. It does so when investors in general are uneasy with the outlook for stocks. And thirdly, markets are rational and mean reverting. If the tactical asset allocation manager can identify departures from equilibrium in the relative pricing of asset classes, the manager may try to exploit them with knowledge that departures from equilibrium will be temporary. So the tactical asset allocator should be aware that if a rule for trading leads to superior performance, investors on the losing side of the trades may eventually stop playing. Market prices will then adjust to reflect changes in supply and demand, and the trading rule may cease to work. Furthermore, the tactical asset allocator should be aware that the deviations from fair value based on historical analysis could persist if the economic environment has changed. Factors such as changes in assets' underlying risk attributes, changes in central bank policy, changes in expected inflation and position in the business cycle need to be considered in evaluating relative valuations because they can either mark changes in return regimes or otherwise explain current pricing. So basically, people that are taking on the tactical asset allocation strategy need to be wary that their bets or their attempts to try to exploit some disequilibria may fail. And we know from behavioral finance as well that people that trade often do not make profits. But this is what tactical asset allocation is, and you need to be aware of the strategy.